Now let's mind your business for a bit. And ABSA Bank Kenya released its half-year earnings on Thursday, reporting a 13% increase in net earnings to 6.3 billion shillings. Julian Samboko sat down with the bank's Chief Executive Officer, Jeremy Awori, and began with a focus on the bank's intended venture into the investment banking space.
Jeremy Awori, welcome on set.
Thank you. Glad to be here.
Yesterday's earnings were heavily skewed towards diversification of your revenue engines, and I'd like us to start from that point. I was pretty much intrigued by the option of venturing into investment banking, and more so because if you look at the investment banking landscape in this country right now, because of the thin volumes from the typical equity and debt brokerage, there's so much consolidation happening. What would be ABSA's play if you venture into that?
Yeah, I think where you started on diversification, one of the strategies that we had was to diversify out our business. And we had a target of having wholesale bank, retail bank being 50-50. We're already there. Before, we were much more tilted to the retail bank, contrary to what a lot of people think. People thought we were a corporate bank. Yeah. So now we've kind of got that 50-50 because we've grown our business banking, which is SME, as well as our corporate. Now, when it comes to the investment banking side, when we talk to our customers, they're doing a lot of interesting transactions, right? Some are acquiring, others are expanding into the region because they also want to diversify away from Kenya, and they've got competitive advantage that they want to be able to take advantage of. So we have often found that they go to third parties to get that advisory. And we have these capabilities within the group. In South Africa, we've got a big investment banking business. So we're able to call upon those resources. But in addition, now we're also setting up our own resources on the ground here that will serve not just Kenya, but East Africa. Because it's as you say, you do need some scale in terms of transactions. So maybe if Kenya isn't doing as many, maybe Uganda might be doing some, or Tanzania might be doing some, because you still got to pay for the team. And then I think there's also transactions which may not necessarily be those huge ticket transactions. There's a lot of private equity transactions that are happening within the fintech space. And I think the challenge for us is how do we provide that service in a way that makes sense in terms of pricing for those transactions, but also makes sense for the bank in terms of returns. And we see a big opportunity. We don't exist in that space, so it's the only way really is up, and we're pretty confident we'll be able to do that in the future.
When ABSA gets into that space, would you be sector agnostic, or would you be open to all kind of across the sectors? And I'm asking this because sometimes in the deal structuring side, you can be overweight with some risks on particular sectors.
Yeah, I mean, our strategy will evolve. I mean, right now we're setting up the team. I mean, I think the macroeconomic environment is also going to influence this. We've seen what's happened in terms of FDI flows. They've kind of slowed down a bit just because of the global macroeconomic environment. I think the next few months, as we've seen, will influence a lot of things. I think it'll more influence outlook, whether people are optimistic, whether they want to come in, what they're experiencing out there in Europe, the US. So for us, you'll hear more as that really unfolds as part of our strategy. But right now, it's really more around supporting our clients, and we've got a broad base of clients. So I guess we'll look at each transaction and make sure that we can add value in those specific transactions as and when they come up.
Tell us about ABSA's play within the MSME space, particularly in an environment where, whether perceived or actual, the risk perception is that things are really deteriorating.
Yeah, I mean, as a core part of our strategy, we really believe in the SME and the MSME space. It's driving this economy in terms of employment of people, just generating income. And so what we've got is we've got a very specific business banking unit that looks at that. And we've got very wide range of propositions, whether it's trade propositions, transactional propositions, lending propositions. We've probably got one of the highest unsecured limits. You can borrow up to 10 million shillings. We've simplified the processes to give credit quickly. We've got invoice discounting up to 50 million shillings. We've got a women in business proposition that really supports women and young women at that to go into business and grow their businesses. So for us, our business banking and SME business is growing in the high teens at least. Our overall lending is growing in the high teens. Private sector growth, if you look for the same period, is at 12%. So we're clearly lending more. And make no mistake, we're careful about our decisions. It's not any kind of reckless lending.
Okay. And speak to the issue of the current strategy. 2018 to 2023, and particularly with the pillars of growth and transformation in a retail rush market like Kenya, where, as you began by mentioning, the perception was that you were more of a corporate entity?
Yeah, I mean, we were very clear when it came to the growth, transformation, and returns. So one was, the previous strategy before that was kind of stabilizing the business. The business wasn't growing. We needed to invest in the business to prepare ourselves to grow, and we did that. We've been, we were trimming our business, getting out of the businesses and areas that weren't delivering value, and we did that well between 2013 and 2017. That freed up capital for us to invest in more tech. So we've invested more than 5-6 billion just in tech, and you've seen a lot of those things coming out in some of the offerings that we've talked about, whether it's WhatsApp banking, whether it's our digital finance Timiza platform, getting into bank assurance, etc. So now when it comes to this phase, it's been much more about growth. So if you look at our growth, the revenue has started really picking up, and now you've seen it. Last year we were at 7%. This year we're at 17%, and it's broad-based, non-funded income as well as interest income. You've seen our assets growing almost 20%, and it's growing in some of these new exciting areas: the SME sector, corporate, and retail. So the growth agenda was also to diversify out, and we're excited that all our businesses are double digits. So it's not lopsided. It's not like we did some few huge corporate deals and our retail business isn't performing or our markets business isn't performing. So we're really bringing them all together. On the transformation side, it's really transforming in line with our customers' needs, what they want to remain relevant with them. And we had to do that with COVID. Ways of work had to change completely. And we're evolving and we're working in an agile way to keep pace and to keep in advance of customers so that we can serve them better. And then on the return side, obviously shareholders want returns, right? So you can't give returns, as we saw in COVID. ROEs dropped to single digits. Yeah, I mean, so we've moved from a single digit ROEs where it was much less than the cost of equity to a 23% return. So we're pretty happy. It's now we've achieved the three pillars. Now it's around accelerating into those, whilst managing stability, our capital base, and just really giving sustainable returns. We don't want to be a roller coaster kind of stock where 1 minute we're doing really well, the next minute we're not. And that's what we're known for, and hence our dividend payout.
Hinging on that point, yesterday you mentioned, and I want to quote you, dynamic and sustainable dividend payouts. First of all is that ABSA has declared an interim dividend at a time when a number of peer lenders have held back. Are you guarded about the prevailing macro environment, or how do you view it?
Yeah, I mean, as a bank, we used to pay interim dividend. In fact, it was COVID that disrupted it. And then because there were so many uncertainties, we actually made the choice and said, let's hold back right now because we don't know how difficult this is going to get. And that was when we're in the midst of complete lockdown. So, of course, it was sensible to preserve capital. Yeah. Our business is now growing. It is generating capital. Our capital position is strong, right? I mean, our core capital is at 14.1, our total capital adequacy 16.5. So we're well above. We have our own buffers, and we're ahead of those buffers. So our capital position is strong. We're confident we've invested in the businesses that will throw off growth and our fast-growing sectors, because I think there were sectors in our business that we weren't in. We weren't in digital finance. We weren't in some aspects of trade. We weren't in custody. We weren't in payments. We've made those investments and they're starting to come through. So yes, it is a difficult macroeconomic environment. So make no mistake, we're not rushing headlong into some of these things where we pay for it. In fact, I would actually argue that we're probably more conservative than most of the market. If you look at our NPLs, sitting at 7%, the market is at 14.7, right? You know, so when we look at it, we're careful. We take the difficult decisions around either provisioning or not getting into sectors when everybody else is. That sometimes may look like, you know, it may dampen down our overall profits, but we still get consistency through the cycle, and that's typically been our approach.